All right, today we're going to go through just a few minutes, in fact, 10 minutes or less, on a lesson on life insurance. So, 10-minute lesson on life insurance. So, let's say you're going to buy a life insurance policy with a $500,000 death benefit. Okay. There's a minimum premium that you could pay, and there's a maximum premium that you could pay. The government sets the maximum premium, and the insurance company sets the minimum premium. Okay. Now, that's pretty interesting, right? The fact that the federal government limits how much money one can put into an insurance policy says, what about it? It must be good. More specifically, it must be good in relationship to one subject, taxes. Now, there's a corridor between the minimum premium that you can pay and the maximum premium that you can pay. Policies outside of this corridor don't qualify as life insurance. They're determined to be a modified endowment contract or MEC, which simply means the government will treat the insurance contract like they treat qualified plans with all the rules, regulations, and related penalties, which we don't want that, right? But there's almost an infinite amount of premiums that can be charged between the minimum and the maximum. Actuaries calculate the least amount of premium they can charge and still earn a profit for the insurance company. But in the 80s, the government drew this line. And they determined the maximum amount of contributions allowable given a certain death benefit. That was that modified endowment contract line. That's the maximum that you can put in for a given death benefit. If you exceed that, it becomes a MEC. We've already talked about that. You don't want that. So they accomplished this, by the way, with two laws, DEFRA and TAMRA. TAMRA in 1988, DEFRA in 1984. These two laws said basically the government can't allow you to put unlimited funds in a life insurance policy, because if they did, people may not want to do what the government was encouraging them to do with their money, which is what they wanted to, other than pay taxes, they wanted us to put money in a qualified plan. So 401ks, IRAs, SEPs, and 403bs, just to name a few. So what do qualified plans do? Well, first of all, they defer taxes. More importantly, they defer the tax calculation. Perhaps a more clear word is they postpone the tax calculation instead of defer it. They postpone it. Now, what's the rate when they postpone it? They're not going to tell you that. Here's an example. This is kind of the way to think about it. Let's say you wanted to borrow $10,000. You'd ask two questions before you took the money. Number one, how much interest do I have to pay? Number two, when do I have to pay it back? So let's say that the lender responded by saying, we have enough money right now and don't need any payments. But when there comes a time when we do need the money, then we'll let you know. Then we'll be able to determine how much interest we need to charge you, and we'll let you know how much you have to pay. Would you cash that check? I don't think so. Think about that. When we know how much we need, we will be able to determine how much interest we have to charge you and the amount we need. Now, think about this. The four major expenditures for the government are Medicare, Medicaid, Social Security, and the interest on our debt. What happens when that exceeds our GDP? Taxes have to go up. Right? The government needs more money. Where are they going to get it? From us. All right, back to our insurance lesson. Let's assume that you could pay $1,000 for $500,000 of death benefit, or you could pay $10,000. Which one would you choose? Most people would probably say $1,000. The less is best when it comes to cost, right? Now, the lowest premium is known as term insurance. It has one benefit, death benefit. The only way to win with term insurance is to sign the application, give your agent a check, and then go outside and get hit by a truck. You win. It's a tough way to win, but you win. For an insurance company to expect that you would put $10,000 in a policy with an initial death benefit that you could get for $1,000, they'd have to come up with some pretty serious benefits. Agreed? So let's forget about the insurance example for just a second, and let's just talk about benefits. In any vehicle one would use to accumulate money over time, a major desire would be to maximize the benefits. In addition to getting an acceptable rate of return, if you could wave a magic wand and get the benefits you desire, what would they be? Tax deferred growth? Sure. Tax free distribution? Yep. Competitive rate of return? Yep. Would you want to put a lot of money in there, large contributions if you're getting all these benefits? Absolutely. What if you could get long-term care benefits and terminal care benefits, protection from creditors, things like that? Would you want additional benefits? Sure. Would you want to provide collateral opportunities, meaning you could use the cash that you had in there to use somebody else's money in whatever way you wanted? No questions asked? Absolutely. Would you want the money to be safe? Absolutely. You'd want it to be guaranteed a no loss provision. I mean, you can't lose money. Sure, that's what I would want. How about a guaranteed loan option, meaning that you can take a loan anytime you want? You cannot be denied access to your money. And when you took a loan, who would you want to structure the payback? You or the insurance company or the bank or the finance company? You'd want it to be you. You determine the payment schedule. Would you want liquidity, use, and control of the money? Absolutely. And would you want deductible contributions if you could get them? Sure. Okay. By the way, you'd want the maximum amount of those benefits you could possibly get, right? But which of these benefits do you get from a qualified plan? You get tax deferred growth, competitive return potentially, and deductible contributions. Okay. Which, by the way, means you don't pay tax on the seed, the money going in, but you do on the harvest, the money coming out. That's where they get you. But you're already in. It's already too late once you figure that out, that's not a good thing. There's only one product that offers the majority of those benefits we just talked about. And it's a very specifically designed whole life insurance company from a mutual insurance company. It's a very specifically designed whole life insurance policy from a mutual insurance company. Now, this is not how State Farm or New York Life or Northwestern Mutual design policies. This is the way corporations and banks design their policies that they own. All right. So permanent life insurance contracts offer all of the listed benefits except life insurance outside of a qualified plan is not deductible, which means it's kind of like a Roth. We pay tax in the beginning and we don't pay tax when the money comes out. Makes sense. All right. However, not just any type of policy will do. Life insurance minimally funded will only provide minimum levels of benefit. So as you move from the highest possible premium down to the lowest, the value of benefits decrease. The higher the premium, the higher level of each benefit received until you reach that MEC line. Up to the line, never over it, is the position to provide the greatest amount of benefits a life insurance contract has to offer, while still allowing liquidity, use, and control of your money, which, by the way, is the goal that a bank has with your money. For infinite banking or privatized banking, we design the premium using a paid-up additions rider, not a term rider, because that's just pure cost, to get as close to that MEC line as possible without crossing it, making your banking policy as efficient as possible long-term. Nelson Nash, the creator of infinite banking concept, told us, think long-term. Get it right up to that line. Okay? By the way, now you understand more about life insurance than most life insurance agents. How do I know that? Because I used to teach the classes to get your CFP designation, your chartered financial planner designation. Your certified financial planner designation. and also CLU, your Chartered Life Underwriter designation in Denver at the College of Financial Planning and the American College. And we studied and went through massive detailed examples of life insurance, but they did not train you on how to use your insurance contract and your cash values like a bank. That's why you know more than most life insurance agents know about life insurance now. So if you go to your life insurance agent, that's just your typical agent, trained the way a typical agent is trained, they're not going to have any idea what you're talking about. You might as well go talk to your hairdresser. They'll be just the same, they'll have the same training as that life insurance agent. But if you want to learn more about how you can become your own banker, then go to createtailwind.com, schedule a 1-hour coaching session. It's free. I promise you, you won't regret it. Until next time, I'm Jim Oliver. Thank you for spending a few minutes with me today.